Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 98. If you're listening in real time, this is Memorial Day weekend, so the kickoff to summer. And the topic for today's podcast is going to be commercial real estate. So there's been some hints of some cracks in commercial real estate. We're going to discuss those. We'll discuss what a REIT is and add that to your investment lingo. We also will discuss briefly the debt ceiling and the politicians that are working to resolve that over the weekend. So get your mind right and let's get to work.
You dropped this.
Well, welcome back to the show, everybody. If you've been watching me on Instagram, following our page on Instagram, you'll know the reason I missed an episode was because last week, man, the first time, I thought this would be a good segue, but the air conditioning system in my office building has been like, I'm going to say finicky, but in the last couple of weeks, like it's broken down. And I've come up to the office to record on the weekends, and last weekend it was 88 degrees. And I tried to fight through it. I started recording and I just deleted it. Like it's one of those. It's like a boiling frog, right? Where they say you put a frog in water and you slowly start to turn it up and they won't jump out. And man, I tried to start recording, tried to do it. It just kept getting hotter and hotter. And in my building, you can't turn the air on or off. It either has, it's always on. So if it's not blowing, cool air, it's just blowing hot air. And so I'm sitting here trying to record. And anyways, I gave it a good fight. And I was like, man, this is going to come across, right? It's audio. So you can't really see me unless you watch one of the videos that we do. But I just could not fight through. So I deleted the whole thing and was like, I'll try again next week when the air works. And so because of that, I was thinking, wow, I need to do an episode on commercial real estate because it's one of the big topics that seems to be kind of hitting our the financial news wires a little bit because of how much commercial real estate is out and available, how much vacancy rates are growing in large cities. And so we're going to discuss that because, even after COVID has been done, obviously, we all know that real estate's a lot different, that people are working from home, that even if they're going into the office, they're not going 5 days a week or the entire team is not there all at the same time. And so I thought this would be a good topic of discussion for today. So before we get into that, some of the kind of market news, this is Memorial Day weekend. So the markets are going to be closed on Monday. And the big kind of piece here for the market is whether the debt ceiling gets raised by politicians. And yesterday was a good day for the market on the hopes that there's going to be some type of resolution. And so we'll have to see what that resolution actually looks like to see if it actually comes through. And so, it's kind of a waiting game here, but that's really what is, the stock market is keen off of. That's going to be kind of the big piece. Does that get raised? And then there really is not going to be a lot of news for the market until, earnings come out again. And then obviously the inflation numbers will just bounce around to these news stories. We'll go from debt ceiling straight back to what do the inflation numbers look like? And is the Federal Reserve going to have to raise rates? But normally for the market, the summer is normally kind of a lull period. Travel numbers look good. Looks like a lot of people are going to be traveling over the summer. And so the market usually based on volume rates and things like that, the summer is usually a pretty slow time for the stock market. So plenty of other things to keep ourselves busy with. But normally summer's pretty slow. So when you think about commercial real estate, obviously you think about office buildings, and those are the ones that are kind of, getting the most attention right now. Office buildings, you look at San Francisco, the vacancy rate in San Francisco is 30%, which is about 35 million square feet. And so this is a direct correlation from the issues we had with the technology stocks last year, right? So many of the big technology companies that we have discussed, they're based in Silicon Valley, right next to San Francisco. And so all of a sudden they start letting a lot of people go. And then since they've let a lot of employees go, guess what? We no longer need as much real estate as we thought. We don't need the office space we thought we were going to need, so we're going to give this back to you. And so when you look at the actual numbers, one of the things that you have to realize about real estate is that most people are locked into a contract, right? So let's say that they've had this contract for whatever it is. If it's somebody that's a smaller business owner, maybe it's a 3-year contract, maybe it's a 5-year contract. If it's a big corporation, multi-million-dollar corporation, maybe they're locked into that contract for 10 years, 20 years, 30 years. When you think about mall spaces, you think about kind of what they call the end cap, which is the big stores on the end of the mall, which would be your JCPenney's, Nordstrom's. For a while, it was Sears until they went under. Those big kind of properties, which used to be very, very kind of sacred ground in the mall. Like you wanted that space, but those are normally like 20 to 30 year contracts. And so those have really, Macy's would be another one, but those have really ended up hurting those businesses because that real estate is so expensive. And now not as many people are going to malls. Right? Not as many people are going to malls, and places like Kohl's and TJ Maxx, they're able to sell clothes for a lower price because they're not paying as much for real estate inside of those mall units. And so, there's really is this kind of trickle down effect. But in the next coming years, there's about $1.5 trillion coming due by 2025. From banks, that are just for real estate, and it's going to be a problem. And you're going to see this, or I would expect that you would see this more often coming up in news stories. And how are we going to deal with this real estate that is no longer needed? This commercial real estate that's no longer needed. And so one of the big areas that they highlight is Los Angeles, where most of the commercial real estate in downtown Los Angeles, there's about $230 a square foot owed on that real estate that people still owe money on. And the problem is a couple buildings have sold there this year, and they were sold for $154 a square foot. Now, that difference in a negative way is not good. And so people are starting to look at, okay, so what is this property actually worth now? We're going to have to revalue this down. And real estate is normally, you can do appraisals, you can do things like that, but it's usually comps, right? They're looking at comparables. What did this house next to you, what did this building next to you sell for? What is the value of this? And normally that's kind of how they come up with it. So there could be real estate values that are on people's books that, let's say they bought it for $100 million. It's on their books for $100 million, but maybe it's only worth $75 million. Like they haven't had to write that down yet. And we'll kind of get to that in a little bit. But you look at some of the major real estate holders in the country, and they could be in some trouble. And so we'll look at that, but in just a minute. But you have to think about just why is this commercial real estate important? Well, if you think about an urban area, you think about a city, and you think about the downtown area, it's not just the office buildings. Right? Because when you have people coming to the office buildings, what else are they doing? Well, normally those people eat lunch, right? So normally they eat lunch, they go somewhere, they look for a restaurant inside the building, next to the building, they go eat there. Maybe there's some shopping nearby, maybe they shop, before they go home or whatever. And then normally maybe after hours, they have a happy hour. And they meet their friends and their buddies, and they have a couple of drinks before they go home. They don't want to be in traffic, so they're like, okay, what can I do with this hour? And so what they call this is a doom loop. And so if if people aren't renting that space, there's less taxes. The values of the buildings aren't as much. And so the property values come down, which means the city isn't going to get as much money, which means the city can't reinvest into services, which means there's not as many people there, which again, they're not eating lunch, they're not buying things. So the retail piece suffers. The restaurants suffer, and then the nightlife suffers because people aren't doing happy hour and things of that nature. So it causes this whole issue, right? So now we have more people who are working from home. We have people who are ordering things online. And so this commercial real estate really isn't, it's not as needed. And honestly, how many, Spirit Halloween shops do you need, right? Because we already had Bed Bath & Beyond go bankrupt earlier this year. And so, there's just not as much space that is going to be needed. And so commercial real estate isn't just the office buildings that you see downtown, but it's also medical buildings, medical parks, it's malls. And, people aren't really they're not going to malls as much. And of course, I'm in Texas, and you had the Allen shooting a couple weeks ago at the outdoor mall. So that obviously factors into people wanting to go to malls or not. You have warehouses is another big piece of commercial real estate, which is which actually warehouses, has been growing steadily. But obviously, warehouses for online shopping and things of that nature, you don't have to be in like peak areas as far as like needing to be downtown. You can buy some land outside of town, put your warehouse in, and be good to go. So multifamily homes are also kind of a part of that. But you look at, so what are some of the major reasons that these, that experts are worried about commercial real estate? Well, number one is that normally commercial real estate is highly leveraged. And so if you remember, we talk about leverage on the show. Leverage is a fancy business term for debt. So if something is highly leveraged, that means they have borrowed a lot of money to buy this thing. And so real estate is one of the number one assets you can buy with leverage, borrowing money, because most of us don't have, $60 million to buy an office building or whatever it is. So you go to a bank and you borrow a lot of money to do this. So if real estate goes down in value and you're underwater, so you buy a $60 million building and now it's only worth $40 million if you want to get out of it, that's a problem. And then normally you could value it based on cash flow, right? Well, yes, my real estate, maybe the value has dropped, but I have tenants inside there and they're paying me this much a month. And so the business, this business is cash flowing. Well, if people don't need that commercial real estate and they're not renewing their loans and they're moving out, that is like, two punches at once, right? So now the real estate, now you can't value it based on cash flow because you don't have renters in there. And so that becomes difficult. And then you add on high interest rates. So now if somebody wants to come buy your building, they're not going to be able to buy it at 3% anymore. They're going to have to buy it at 6%, which on a multi-million-dollar building, that has significant consequences, right? That becomes a major issue. And then number three, corporations just don't need the space anymore. I mean, every single day when I'm reading the financial news, I see an article about somebody trying to, they're either laying people off or they're also trying to minimize their footprint when it comes to their headquarters or whatever. I think this past week, Uber was one of them. So they're like, we don't need this much space. Can we give it back? Can we sublease it to somebody else? What are we going to do here? And so, the trends just go away from that. And, banks, they don't really want to foreclose on this property, meaning they take possession, because what's the bank going to do with this property? Are they going to let it be vacant, try to sell it for whatever they can get? I mean, it causes a lot more problems, the tentacles, if you will. If the building is an octopus, you have the tentacles reach out and it impacts a lot of different areas. And so it's something that definitely is something that you need to think about. And so that we have a record number of vacancies in real estate. There's a famous investor, Stanley Druckenmiller. He was talking about it this week. And one of his big points was, which I thought was so interesting, was that regional banks, 43% of their commercial loans are normally in real estate, with 40% of those being in basically office space. And, we've talked about it a lot on the show already this year, but regional banks have not had a good time this year, right? It has not been a good year to be regional banks. And so this would be one more shoot a drop for them, more like an anvil. I mean, this could be a major issue, especially for regional banks in certain areas, where maybe, if they're in an area where really downtown has not come back, business isn't the same, this could be a major problem for them. So, and it's not just them, right? So here on this show, I don't know if any of y'all own commercial real estate, but you might, and you might not even know it. So the main way that retail investors invest in commercial real estate is through what's called a REIT. So REIT, R-E-I-T, which stands for Real Estate Investment Trust. So if you look at your investments, some of your mutual funds, maybe you have a portion that is slated towards real estate. Most likely it's going to be in a real estate investment trust. And in those real estate investment trusts, they have certain rules. So in order to be classified as a real estate investment trust, 75% of the assets need to be in real estate. 75% of the income that comes into that fund needs to be from real estate. And the key here, and the biggest point for you to remember, is they have to distribute 90%. 90% of the income that they receive has to be distributed to shareholders. And usually that takes the form of a dividend, right? So normally real estate investment trusts pay big dividends. And real estate has historically been a nice hedge against the stock market. And so there have been, plenty of people who invest in real estate or real estate investment trusts as a way to, number one, kind of diversify their portfolio, but it also has historically provided good current income for those investors. Okay, so that's kind of the main points of this. But over the last couple of years, if you look at some of the real estate investment trusts, my warning to you is that one of the biggest mistakes I see is that people buy into a real estate investment trust based primarily on the dividend. And I'm here to tell you, I always try to be as honest as possible. Some of the biggest investment mistakes I have ever made in my career are because when I was younger, I would look at something and go, man, it pays a really good dividend. I'm going to invest in that. And I didn't really look at the company. I didn't do my homework. I didn't do the deep dive that I should have done. And I was like, well, it pays a great dividend. And so I'm going to invest in this. And then all of a sudden, as soon as I invest in it, the stock continues to get beat up. And so I want to share with you, there's a ton of real estate investment trusts out there, a ton of REITs. And the one thing that you have to understand when you start looking at REITs and you start doing your own research is a lot of times these real estate investment trusts will focus on a certain area of the real estate market because obviously it is a very big market and companies normally tend to do better if they concentrate on a certain area rather than just try to be, real estate magnates in all kinds of areas. And so some of the ones I want to highlight here for you is one called Macerich. The symbol is MAC, and they primarily do a lot of malls, shopping centers. 5 years ago, the stock was $58 a share, and today it's $9.66, but it does pay a dividend of $7.30. Oh, I'm sorry, not $7.30. It pays a dividend yield of 7.3%. Sorry about that. There's one called DLR, which is Digital Realty Trust. It is actually a company I've followed. I've liked it. I've invested in it for a while. I'm not currently and don't have anybody in it right now. But in 2021, it was $176 a share. It's currently $98, and its dividend is 5.29%. Now, Digital Realty Trust, the reason that one caught my eye and I gave it a look and kind of really do like it is because their office space doesn't really have human tenants. So Digital Realty Trust, they specialize in basically commercial office space where they house servers for all these companies that have to have servers for the cloud and all their digital assets. And so they really just need a building that has a really good air conditioning system, unlike mine. Mine definitely wouldn't qualify. But I mean, what a tremendous business, right? I mean, you think about all these businesses, they need space. They gotta store these servers somewhere. They gotta just, they really just need, a great air conditioning system, but they got to be able to put this somewhere. And so Digital Realty Trust is the one who houses that. But even that one has been beat up just tremendously over the past year. There's NLY, which is Annaly Capital. And this one is one that I got burned on years ago. 5 years ago, it was $42 a share. Today, it's $18. And here's the one. This is why this one gets people. It pays a dividend of 14.6%. And so that 14.6% dividend, man, does that catch people often. And then there's SPG, which is Simon Properties, another big mall outfitter. They were $176 5 years ago. They're now $102, and they pay 7.31%. And so over the last 5 years, obviously with COVID, these took a massive hit. Even some of these, if you go look at their 5-year chart, you'll see that they took a massive hit, came back up, and now they're slowly starting to kind of turn back down. And we just really don't know how this is all going to end up. But it is something that's a major concern, and it should be a concern. It should be something that we think about because it's not just about the real estate, right? It's about all the other answers that I talked about earlier, as far as it just impacts other areas of the economy because, if people aren't in those places anymore, it kind of just moves things around. It hurts the restaurant business. It hurts the retail space. There's a lot of kind of things that it impacts. Maybe oil companies with people not driving as much, maybe car companies because now you don't have to replace your vehicle as much. And so it really does have a wider net than most people realize. And so I don't really know how this is going to turn out, but I do think it's something that you need to think about. You need to kind of take a consideration of it as far as your portfolio is concerned. Obviously, this isn't investing advice. This is for entertainment and education purposes only. So please talk to your financial advisor to kind of get specific advice for your situation. But I always like to think about when things are getting beat up and real estate is obviously getting beat up, it puts it on the radar for me because there will be some companies that get beat up, just like the tech companies that we've discussed over the past year. There will be some companies that are going to survive and they're going to do very well. And so it's really more about, okay, who can I go in there? What area do I think is still going to perform well? And they will be able to make it through the storm, right? Those are the companies that I want to think about. And, maybe there's somebody that's getting, beat up somewhere. Maybe that Digital Realty Trust, right? I mean, that's going to be obviously real estate for servers and for, cloud computing space, especially with AI technologies coming up. And you got to put those things somewhere and they got to run somewhere and you got to keep the servers cool so they don't break down. So that one is, again, even when I looked at it years ago, that one is still, when I think about the investment thesis for that, always makes me want to go in there and look at it a little bit deeper. So I hope this was helpful for you. I hope you gained something here. And as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.